Welcome to the What's Your Deal podcast, where we discuss business acquisitions, investments, management, and exit strategies. I'm your host, Matt Uhler. Let's dive in. Welcome back to another episode of What's Your Deal. Today, I am joined with Eric Wiklendt. And Eric's the managing director of SpySide Equity, where he leads private equity investments in industrial and manufacturing businesses. What makes Eric unique is that he's not just an investor, he's a true operator who spent years leading companies from the inside. Before private equity, he was a CEO and held leadership roles at companies like Eaton and Hilti, building operations and driving growth in complex industrial businesses. Today, he brings that hands-on experience into every deal, helping transform underperforming companies into high-performing businesses. Eric, welcome to What's Your Deal?
Thanks so much for having me, Matt. Really appreciate being on with you.
Yes, and I'm very much looking forward to this topic because it's a topic we have not covered in the past on a podcast. So I think it'll be very educational. And I know because of your compliance issues, there's some really exciting words you want to share with our audience, just as a disclaimer.
Yeah. Yes, sir. So, more money, more attorneys is how this works. But yeah, real quick, all expressions of opinion provided in this podcast are subject to change without notice and are not intended to be a forecast of future events or results. There is no assurance that the trends highlighted in this podcast will occur in the future or that the projections, if any, will be met. And I guess I would further add, we are not currently raising a fund, so we're not looking for commitments anyway. So that it's a belt and suspenders approach to the disclaimer.
Very good. Well, I certainly understand the need. So with that behind us, let's talk about SpySide Equity, and I'm really curious about what SpySide is interested in and the types of opportunities that you want to pursue. But I also want to bring some of the mentality and mindset from private equity as an example, and what private equity looks for that might be different than Main Street.
Yeah, sure. So. And I'll tell you, SpySide's a little bit different than like the average private equity firm. And here's why. We tend to be a firm of operators built for operators. And as a result, we, as you would guess, have a very operational bent to what we do. And that's how we generate create our value creation or equity value creation, which is a very systematic approach to portco value creation, which we call our fix and build portco value creation system. The thing that's a little bit different though with Wall Street versus Main Street, if you can think about it that way. So private equity is a little bit different than publicly traded equities and how we look at things. So in private equity, we're looking to buy privately owned businesses, keep them private, in a capitalization structure, both debt and equity, that makes sense for that style of investing. And generally speaking, in private equity businesses, we have an assumption of a hold period of 5 to 7 years, whereas like in a publicly traded equity, a lot of the assumptions that go into kind of like theory of the firm, if you will, that folks will have learned maybe in a finance class, it's an assumption of perpetuity, so like forever. Right. And that really matters, how you think about things. So you kind of think of it as like, I'll hearken to my son's college lacrosse team. We're on a shot clock in private equity. Whereas, Main Street, publicly traded equities, they have perpetuity, although they have quarterly earnings calls where they're talking about what's going on. So they're kind of really long and then also really short, whereas we're like more of a midterm thinker in terms of thinking about value creation.
Well, that's actually very interesting because 5 to 7 years, I'm assuming that changes significantly what kind of company you're looking for. I mean, you've got to figure out something great to do with it in that time frame to be able to exit at a much higher number than what you went in at ideally. So what kind of things are you looking for? I mean, I can't imagine distressed. You're looking for opportunity, or what's that approach?
Yeah. So for us, like at SpySide, we're a little bit different from the perspective that we like a fix and build strategy. So a lot of times we're buying companies in misaligned ownership structures where it's a little bit of a hairier deal. And so it needs to be structured to meet the seller's needs, either in terms of dealing with retained liabilities or, what the seller wants at a sale relative to taxes, or sometimes it's optics or whatever. And that's okay, because generally those companies, if they're in a misaligned ownership structure, sometimes they're a little bit like underloved and therefore undermanaged and therefore underperforming, which is all right with us. We don't mind dealing with deals where structuring's needed and transformation's needed. And we do that transformation in the portco value using the portco value creation system. It's a two-phase approach. Phase one is fix, phase two is build. The fix phase is all about improving the EBITDA margins through operational improvements. And then phase two is all about the build or growing the top line through either acquisitive organic actions. And in that playbook, so to speak, that portco value creation system, we have 27 plays that we like to run. And then we're looking for businesses where we can do that in a 5 to 7 year hold period where it makes sense, where, basically we're trying to, in the first 2 to 3 years, double the EBITDA, generally by doubling or tripling the EBITDA margins. And then in the next 2 to 3 years, we're looking to grow the top line such that we exit the business better than where we found it. And, it's kind of one of those situations where it's a little bit like house flipping, I guess, is a good analogy, where it's like you buy something where, maybe the landscaping doesn't look perfect and it needs, a new coat of paint and some new floors and maybe some new appliances, something like that. But that's fine with us. That's our model. There are other models in private equity. One model is a financial engineering model where a lot of leverage is used and a small equity check is used. We don't tend to do that. And then another model is more like a roll-up strategy where you buy the biggest competitor in an area and then bolt on a lot of smaller things. We will do that in our approach, but that's like a second phase sort of thing that we'll do.
Interesting. Okay, there's so much there to unpack, but it's really fascinating, actually. And so I guess a couple of questions, and one of them you may or may not have the answer for, but how often do you get what you expected? You bought it, you're able to increase the EBITDA, then you're able to grow, and then you exit. I mean, is it half the time you get surprised or?
Yeah, great question. I would say that, and I'm going to use a kind of heuristic rule of thumb, probably 80% of the time, 70 to 80% of the time, we've got the things that we thought that we were getting, good and bad. 20 to 30% of the time, and this happens in every deal, just because there's, you only have so much time to do operational due diligence. You can't boil the ocean relative to due diligence, and nor do we. I represented our portco value creation system. There's 27 things in there, but we don't do all 27 things in a deal. It's usually 3 to 5 key items. But what that means is after we buy something, there'll be things that we discover, both good and bad, where we're like, oh, didn't that one wasn't on my bingo card. Didn't see that one coming exactly. And again, it can be good or bad. They tend to kind of balance out. However, if we're looking to do execute 3 to 5 key deal theses or ways that we're going to create value in the company, how we tend to set up our deals is with a belt and suspenders, risk mitigation approach, from the perspective that we want to kind of know that if there are 5 things that we say, hey, we think these are the things to do to improve this business and create equity value in the business, we kind of want to know that if 1 or 2 of them don't go well, there's still enough meat on the bone to create value in the business and have a good deal and have a good exit. So knowing that there will probably be 1 or 2 things that happen positively that kind of makes up for that. And that's kind of how we approach it. But yeah, there's always things that you find in any company that you buy where it's oh, that's interesting. That's a good learning to have here in the first 3 to 6 months.
It sure is. And it just seems like it's inevitable. I mean, no matter how many rocks you turn over, a lot of businesses are just so driven by people. There's just going to be stuff. And it sounds like it's no different. Yeah.
Yeah.
And so
100%.
for perspective, so what size transactions does your firm focus on and is your sweet spot?
Yeah, so 50 to 500 million in revenue, 2
Okay.
million to 70 million in EBITDA. But what, oftentimes we're looking for is something where we can improve it somehow. So we love something like our perfect deal. People ask us this all the time, like, what's your perfect deal? And the perfect deal is like 300 million in revenue with like 5% EBITDA margins that we see a path to like 10 to 15% EBITDA margins. Or, we bought businesses where it's like our first deal in fund two, it's like we're looking for like going from like 10% EBITDA margins to like 20% EBITDA margins. But we want to find things where we can improve the business through a pretty clear, controllable path is the key. And I say 50 million to 500 million. Personally, I really like when we say 50 million to 500 million dollars. It's a quantitative metric to represent a qualitative concept. And what I mean by that is businesses below 50 million in revenue that need a transformational approach. Usually, they don't have the scale in terms of processes, systems, and people to do an improvement plan that's meaningful. Just because small things will kill small businesses. So we've kind of just said, going forward, bright line, businesses below 50 million in revenue as a platform that need a transformation, that need the phase one, we're just not going to do. And then things over 500 million, again, it's a quantitative rule of thumb for a qualitative concept. But the issue why we say 500 is the max. It's not like a hard number per se there. But what we notice is like businesses, manufacturing businesses like we like to buy that are over 500 million in revenue, because of their size and usually, because of what we're buying, they have a lot of bureaucratic inertia working against us. That makes it difficult to make changes that we need to be able to make that create the return profile that we can create in the 5 to 7 year hold period that we would have something. So said more simply, in manufacturing businesses that we like to buy, these 50 million to $500 million revenue manufacturing businesses, when you get to like $500 million in revenue, you got to reach down too many levels of the organization to get to the people that are actually doing the things that customers are really paying you for, being manufacturing products, developing products, and selling products. And if you're 5, 6, 7 layers deep in, management, that's too many layers, too much bureaucratic inertia to go through to be able to make changes when something's not performing as well as it should be.
Yeah, that's fascinating as too. There's so much that I'm curious about because, again, Main Street businesses being what I've focused on primarily for my career. Again, you don't have 7 layers deep, right? But you can still have huge problems at 1 layer. So,
sure.
So I guess to close the loop on what you like as a firm, how many deals do you try to complete per year? And then I want to dive into the fix aspect of what you talked about.
Yeah, so we'll probably look at, and it's actually increasing just because we've been reprocess engineering our business development and sourcing processes. But I would say we seriously look at 100, SIMs a year. And when I say seriously look at them, that means we end up putting an indicative bid on the business. So like a couple a week, sort of a thing. We're writing an indicative offer. So we probably look at, more SIMs than that. It's probably 200 we actually get the SIM, and then 100 we write an indicative offer on, and kind of go from there. But we've noticed there are opportunities to improve that based on what we did in previous funds. And I would say that previously we had some processes where we were really great at being very proactive in terms of deal sourcing. And then we had some other flows of deal flow, which frankly, they were great sources of deal flow, but we were being kind of reactive, right? So it's more like we were being like spider in the web, waiting for something to fly into our web, right? Versus being like an eagle, flying around and surveying the territory and then hunting swooping down and, in and on a deal. And that was fine. We got some really great deals done. But what we've done better in this fund over the last 6 to 12 months is we've taken those processes where we were much more reactive and just kind of waiting. And now we've made them proactive. And what that's done is it's widened out the funnel and it's deepened the funnel. So more quantity, more quality of deals as a result of that process reengineering and continuous improvement efforts in our fund.
Okay. And so once you have a target and you're in discussions, we'll say, how far, I'm trying to quantify, you might spend weeks, months, years conceivably pursuing a deal and then it just goes away for some reason or another? Or are you able to vet it enough in the first short period of time to be able to say, listen, we're putting our time and energy in the right spot?
Yeah, we're able to do it. And that's been part of the, process improvement, continuous improvement that we've done, where we've gotten, we were pretty good at it before, but we've gotten even better at filtering quickly and killing quickly. So we have a process that we call the value accretion framework. And there's kind of 4 parts of it that go into it. Number 1 is the Portco value creation system that I alluded to. That's all about how are we going to improve the EBITDA and grow the sales of the business. And then there's a multiple accretion framework to think about, like, hey, what's the right multiple for this business if it were like perfect, and how far away from perfect are we? By the way, spoiler alert, no business is ever perfect.
Right.
And then we have a process assessment framework and a human capital assessment framework that feed all into that. And so the deal making process for us is a very, very, very integrated approach. Because like those 2 things, like the structuring and the transformation, they work hand in hand, right? They go together, like they're different sides of the same coin, and they need to be thought through and considered as you're doing a deal, because you need to structure it properly based on the transformation you want to execute. And by making the process very integrated, using that value accretion framework that we've engineered and integrating it with the sourcing framework we've engineered, it works really, really well. And it also creates like a hyper responsibility and accountability in our team, because we tell our team, like, hey guys, like, there is no, deal team and ops team. It's all one team. So if it's wrong and we don't deliver the, returns we're looking to return, there's no finger pointing. The finger gets pointed at everybody on the team. And part of the reason why we want those processes is it allows us to go back and do, basically after action reports and think about, like, hey, did we use the process the right way? If yes, great, let's keep doing it. If no, how do we, then do continuous improvement to make the process better so that doesn't happen again?
Very interesting. And when you refer to a team, how many people are on the acquisition team as opposed to the ops team?
Yeah, so we have, I think it's 12 people total. 12 people total in the fund. And then we have operating partners that we like to use. And there's kind of levels of operating partners for us that we've created a database. And because we like to match the operating partners up with the human capital assessment framework to make sure we get the right operating partners on the right deals that require the right deal theses, so that the operating partner can help quarterback those deal theses. But in operating partner, in that database, there's like a little over 100 right now of people, and there's like 15 at like a level 1, another like 40 at a level 2, and then the rest would be like a level 3. And then people can move based on assessing talent and what's going on. People can move between levels depending on what's going on, and also, depending on what a deal needs potentially as well.
Yeah, it's interesting. It's one of the things that I appreciate about what you're sharing is that it is very structured. You've used the term framework many times, and process and so on and so forth, that literally it's a path that's already been defined and developed and walked many times. And you're just literally rinse and repeat as much as possible, it sounds like. but it still is unique to each deal.
Yeah, and that's for a reason. And I'll tell you what the reason is that and the you can go like read the Harvard Business School studies, or I think Goldman Sachs did one recently as well. But there's many people have studied this, and there's statistics to back this up. But what you'll see is that there's a pretty strong higher return on investment for like smaller focused deals. And so we've obviously read the literature because we like math and surveys and studies. Like a little bit of math nerd. I tutored statistics in grad school at Wharton, so I love these statistical research reports and love to read them. But what it shows is that your IRRs tend to be better in the lower middle market in funds that are very focused on a specific strategy. So we focus on lower middle market manufacturing companies, 50 million to 500 million in revenue, where we can take a very systematic framework, process driven approach to improving the business and increasing the equity value. So then you think about that, like, okay, well, what does that mean? Well, we want to continually get better. It means we want scalable, repeatable processes. If we know that's a great place to create value, then the question just becomes essentially like, what is the nirvana asymptote? What I like to call the nirvana asymptote. So like, how do you get as close to perfect as possible? And the answer for us is that we deliver, good return deals, but we do it like faster and better, as we go. So we want to stay in the same place where we do these lower middle market manufacturing deals. But by doing the process engineering and the frameworks and the systems and all of that, it allows us to just keep getting better and better and better and deliver, scalable, repeatable results that trend toward that nirvana asymptote.
Yeah, fascinating. And so I'm assuming otherwise you wouldn't have the opportunities that you do, that the current owners of the business or management team just doesn't know what you know, or your team knows, or have the ability to fix or even identify what the problems are, or maybe they don't have the enthusiasm. Like what's that like in the companies that you target? Why aren't they doing what you're going to do?
Yeah, great question. And the short answer is oftentimes it's simple, but it's hard. And it's kind of like, okay, why don't we all have 6-pack abs? It's simple, right? Don't eat any fat and go to the gym 2 hours a day, and make sure you hit your core workout 3 to 5 times a week. But it's hard, right? Because like we have jobs and lives, and like I don't have 2.5 hours to work out every day. Unfortunately, I've got like an hour 3 days a week. So It's simple, but it's hard. And same thing here, right? It's like, okay, sometimes you got to take the medicine, and there's a few things that make it hard, right? And if I were to pick one that's like, okay, well, like, is it always this? No, but like, pick the thing that like, why, Eric, do you think it's like simple but hard? And I'm going to tell you this: it comes out of people, right? Because again, we're all human beings, and we want to be good people, and sometimes we need to make difficult decisions and have difficult conversations. And sure, that's simple. I can tell you exactly what needs to be said and what result needs to be created, but it's hard. And so I think that that's a good part about us having that process framework driven approach. It makes that simple but hard a little bit better, because you have you have a script, you have a plan, you understand that it works, that's important. So that's part of it. And then, the other kind of like people part of it is like, these things don't get broken on their own or get underperforming on their own. Again, it's usually a function of like people maybe not as focusing on it as much as they should, owners and or sellers. And sometimes they have to be kind of honest with, what's going on with a certain situation. And again, that's sometimes a little bit, uncomfortable, and that's okay. Like we all get that. We've all been in those situations, right? Like I'm sure we, all had a breakup of a significant other in like high school or college. And the first time you did, it was like the most uncomfortable thing you've ever done in your life. But like, as you get older and understand it, it's like, all right, we just got to like make a plan to move forward here.
Mm-hmm. So do you see that often when you take over a business? Is there significant human resource loss or transition? And what would be significant, or what would you expect?
Yeah. So for us, what we tend to think and the kind of businesses we buy, again, 50 million to 500 million revenue manufacturing businesses, there are usually 3 to 7 really key people in the business that are significantly overweight, impacting the equity value in the business. That's not to say, everybody in the business doesn't have a role, and everybody's important, but I'm just saying, like, there are certain things, just like in any organization, there's a overweighting, in certain cases of certain situations. Just like, you watch NFL football, if you don't have a good quarterback in the NFL, your team's not going to be good, right?
Mm-hmm.
It's just it's just how it is now in the NFL, right? So you got to have a really good quarterback. So same thing in businesses, right? There are certain positions and certain abilities that really matter in certain businesses, and generally it's 3 to 7. It could be, a little bit more at times, sometimes a little bit less even at times, but it's 3 to 7. Now, what we find generally is that we do not want situations where all 3 to 7 key people need to be changed in a business. That usually is a red flag, because it means either the business is in a situation where like you just can't it just can't be successful because of its market position or the competitive dynamics or what it's offering, or it means that like the business is so far gone that like literally there's nobody good in the business that on which we can build a transformational plan. But like a lot of times there are 1 to 2 people that either, to use Jim Collins's parlance, they're either on the wrong bus or they're in the wrong seat on the bus. So and that's okay. Like we have direct, open, honest conversations about that. I will tell you, like 95% of the time, those people know it. And oftentimes when you broach the subject with them and you do it in a nice, polite, respectful way, they're like 5 minutes in, they're nodding their head going, yep, you're right. And what do what's the path forward here, guys? Like, and the answer is either get off the bus and we'll exit you politely and nicely, or let's put you into a different seat on the bus where you can be successful. And let's, build a great business together and create a bunch of value and, move forward. And it's, it happens all the time. You see this in any organization, right? Back to my football analogy about the NFL. Like, I remember, I had a high school sports team, a high school football team, and we had a guy that he was a quarterback and he probably wasn't the right guy to play quarterback. So he got switched to slot receiver and, then was all state. So perfect. Let's do those things.
Uh-huh. Yeah. So, and you alluded to this, but I'm just curious, how often when you're looking at a deal and evaluating it, do you pull away from it because of the people on the bus? Like, you know what, you alluded to, there's just too many that could be a problem. Again, human beings change all the time. So you identify that up front, it sounds like, but it also doesn't sound like you're losing sleep over 1 or 2 if you need to change positions with somebody.
1 or 2 is fine. And, yeah, no, you're exactly right. And, sometimes it can be a huge value creator, right? It's like, depending on who the 1 to 2 are and how much political, I guess power they have in the organization. We found a lot of times when there's the 1 to 2, they're often the times kind of, detracting from the value of the business. And to use my 99th analogy here, but it's like, it's a bit like those people are like, think of it as like holding a beach volleyball under the pool water.
Uh-huh.
And then, that business is being held underneath. And then you get rid of the constraints, those 2 people, which are, the 2 hands on the ball, holding the ball under. And guess what happens? The ball like shoots up and, to the surface. And same thing with businesses. You release those human capital constraints and that ball will fly out of the water and onward and upward to greater EBITDA and greater sales. Just because, again, you relieve those human capital constraints, either get them off the bus or get them to the right seat on the bus. And, a lot of times that's just it's the biggest issue. And we're fine with dealing with that. To your point, 1 to 2 is no big deal. If it's, all 7, that's a problem. And it can be two issues. They're, either integrity or talent. So the integrity thing for us is just a complete no-go issue. And I would also throw attitude maybe into the integrity pot. We have a kind of a no, I won't say the bad word, but the no a-hole rule at our firm. It's just life's too short. So we just won't deal with it. We see plenty of deals, and if part of what it's going to take is dealing with somebody who's pretty surly, then we're just not going to do it. It's not worth loss of hair or extra blood pressure medicine or something. It's for people. But then sometimes sometimes it's a talent issue too, and those we're happy to have those conversations, and sometimes they need to be replaced, and sometimes they just need a different job where they can contribute significantly in that job.
And does that, in those situations, does that create a human resource gap for a long period of time, or you're able to, fill that position and you've got connections and resources?
Yeah. So the short answer is we usually fill it pretty short term. What we'll do oftentimes is either somebody on the deal team or the operating partner or a temp person or a boutique consulting firm person will have fill the gap until we can find a permanent replacement. So we have several options, and that works really pretty well for everybody, because if somebody's not a good fit, they don't want to be there, and we want to make sure that they're off to their next best thing. So that's what we'll do. We'll kind of backfill them short term, and then find a longer term solution, either through our network or through, if we can't do it that way, through, headhunters that we like to work with.
Well, that's great. Part of what I'm enjoying so much about this conversation is, for a lot of Main Street businesses, buyers, they're terrified of having a human resource interruption. So if there's a key employee, will they sign an employment agreement? Will they stay long-term, and how long? And again, they could be the one holding that beach ball down, to use your analogy. And it gets scary, right? Especially if you've got a much smaller team and one key person that might carry a lot of weight that could be hard to replace. At a Main Street level, it's much more, it sounds like, difficult than what you deal with. And the way you're dealing with it, again, with a methodical approach, and here are the resources to fill the gap. And if they're not the right fit, you don't want them anyway. I like the black and white approach.
Yeah. And those smaller businesses, again, it's really interesting situation in smaller businesses. And with those smaller businesses, sometimes they don't have, the scale in terms of people, processes, and systems to deal with much disruption. It's said differently. Most of the and this just makes complete sense. It's a resource situation, right? In smaller businesses, what you would call Main Street businesses, people are spending all their time working in the business versus on the business. So they're spending all their time running the business versus thinking about how to process improve or continuously improve the business. And that's a tough thing about smaller businesses. And it's always an interesting question of, in any given industry, what's the right level of scale where you get to that point, the tipping point, where you can work in and on the business such that, it's like you're not just, sitting out in the ocean treading water, you're actively swimming toward shore so you can get up on and start walking and running toward a larger goal.
Yeah, it's great information. And so let me ask you one more question, and then I want to talk about your operating partner comments you made. But do you use personality profiles or tests with key people when you're in the acquisition process?
Yeah, a lot of times we'll do it, and And we use one we like to call PI, which is personal index. It's a fairly short test, and you get like a 3-page report. What I love about it is we have a lady that we like to work with. I used to work with her at Eaton Corporation way back in the day. She was a VP of OD then. But what you can do with these personal index reports is you can kind of mix and match and see like where teammates will work well together and where they won't work well together.
Mm-hmm.
So if you're building out a new team, it's really, really valuable because that is a very systematic approach to understanding psychological and personality profiles and getting ahead of things that like are just like known. Like, if my personality is way different than your personality, we may need to think about how we communicate with each other because you think about things a little bit differently than I do. And I need to keep that in mind when I'm talking to you about like what's important to you. And you should keep it in mind when you're talking to me. And so that like when we're having a conversation trying to solve a problem, we do it in a way that we can both connect with each other as well as possible. That's the, psychology, like one-on-one psychology. But then there's also some sociological analysis, or some people would call it organizational psychology. They're kind of the same thing, but whatever, semantics. But you think about like how a whole team like works together and how a whole organization works together. It's like or groups of people, work together. And so we'll do those, and those work really well. We found it's like a good kind of quick, hands-on, get you a lot of the information you need very, very quickly. And then, we can have our boutique consultant come in there and run the workshop over 2 to 3 days to have the team like level up quickly. So you've heard this saying like, forming, storming, norming, performing. That process expedites the storming and norming. So you get to performing much more quickly.
Huh. This is a fun conversation for me because, again, dealing with a lot of Main Street businesses, the things you're talking about just have huge value. And a lot of the buyers that I've worked with who have bought Main Street businesses that come from a corporate background have a similar, I don't want to say attitude or approach, but just this like, it's bigger than them. Whereas a lot of the Main Street business owner operators, it is them. And there's just such a huge distinction between some of what you're describing and some of what so many small business owners think like and operate with. So,
yeah, I think the big distinction there, I mean, I worked in, a couple different multi-billion-dollar corporations, both public and private. And, in a lot of those bigger companies, they have a lot of phenomenal processes. Sometimes they're a little over process engineered where they're doing process just for process sake. Whereas the thing I love about like what we do in our size of businesses that we like to buy is we're never doing process just for process sake. We're not just filling out the rubric and checking the boxes. We're doing process for cash flow's sake, right? So so I kind of call it like combat business processes, like what really, really works, right? Like, like it's kind of like if you've ever watched like MMA, right? It's like you want to know what really works in a fight, go watch MMA. That's what works in a. Some people would say, well, that's not a street fight. You could fight dirty, which that's fair, but a lot of that stuff works there. But like Taekwondo, that looks like really pretty, like 360 degrees skinny, spinning back heel kicks. Like, it's like, that's probably not the best thing in a street fight. Like somebody's going to catch your ankle and throw you to the ground and jump on top of you. So the point though, is like, that's like us in private equity, especially at SpySide, which is we don't do process just to look pretty. We do process for a result. And the result we're looking to generate is cash flow and EBITDA and improvement in multiples.
Mm-hmm. Well, it's interesting. I love what you're sharing in so many ways. And there's this analogy. Take a cruise ship as an example. It can take a mile to stop a cruise ship once they decide they're going to come to a stop. And yet with you having your company having a 5 to 7 year picture, I mean, even though you might be considered a bigger ship that can't turn on a dime, you've got to do stuff fast with a 5 to 7 year perspective. And so it's an interesting paradigm there.
Yeah, it's funny you use the ship analogy because I use that with our, portfolio company CEOs a lot. And I tell them like, look, especially if it's carve out, right? It's like, hey, you're no longer part of an oil tanker or cruise ship, to your point, that takes a mile to stop. You are captain of a pirate ship. So get out your eye patch, fly the Jolly Roger, get your peg, leg, and hook. And let's do process for cash flow's sake, not for, huge multi-billion-dollar corporation, political or optics or, process for process sake.
Yeah. Well, that's great. Well, unfortunately, we're coming out of time here, but I do like to finish with one question. You've obviously accomplished a whole lot during your career. Can you share a story of somebody who's helped you along the way or gave you a shot when you might need some help that you could share?
Yeah, I mean, I guess like two thoughts there. One is my favorite. Like people ask me, like, kind of like, what's the mantra by which you live your life? And for me, that's God's gift. God's gift to you is yourself. Your gift to God is what you make of yourself. Mm. So I've always thought about like how do you try to reach your potential and like even if you don't believe in God, maybe it's like your parents' gift to you is yourself. Your gift to your parents is what you make yourself, your family, however you want to think about it.
Yeah.
But I think it's important to try to like, a fulfilled life is, as Socrates said, right? An unexamined life is not worth living. So unfulfilled potential life is kind of not worth living is my view a little bit there. Mm-hmm. And so that's really important. And I've had some good mentors along the way, and two of my favorites were one guy. He's actually an operating partner in our fund now that I worked with at John Deere, or I guess for at John Deere, and he was really great, just kind of helping me think through things I wanted to do. And then another guy was a guy I worked for in corporate M&A. At Eaton. He was my boss, and he really helped me the most understand mergers and acquisitions and how to think about creation of value. So, those two gentlemen, I think were really, really instrumental in terms of figuring those things out. And then you get some other people along the way where older folks where they give you really good advice because they're 30 chapters ahead, and they're like, hey, right. this is how the movie ends. You might want to think about it because you're not thinking about it right. So those course corrections to make the most of your potential are always very valued and helpful.
Yeah. Well, I sure appreciate that. And I appreciate you sharing with us a glimpse into your world and what your company looks for and how you go about it. It's like I said, a little different perspective than what we've shared with our audience so far. And so thank you for being here with us today.
Yeah. Thanks a lot for having me, Matt. It was a pleasure to be with you. And thanks for having me on your show.
Yeah, you're very welcome. Well, I hope you enjoyed that episode. It's really fun for me to see different levels of how things work in business and then to try to incorporate those where they fit for you. We'll see you on the next episode. And that's a wrap on today's episode. We hope you enjoyed the conversation and got some valuable insights into the world of buying and selling businesses. Want to be a guest on our show? If you have a deal that you'd like to discuss with us or a business story to share, we'd love to hear from you. Shoot us an email using the contact information below in the episode notes, and let's make this happen. Never miss an episode. Make sure you subscribe on Apple Podcasts, Spotify, or wherever you listen. And if you found today's episode helpful, please leave us a review. It helps more people like you find the show.